Hi, I'm Brooks Ackery with Horizons ETFs. Thank you very much for joining me today. Today I'd like to use the Horizon Seasonal Rotation ETF, ticker symbol HAC, its weekly commentary as a basis for this market update. So let's jump right in and take a look at the action in the markets last week. Here you can see the S&P 500 was down 0.4%. This is in contrast to the Canadian stock market, which was up 0.8%. Now that large difference was largely the result of the Canadian banks performing quite well last week. And so what was happening? Well, a lot of the Canadian banks released earnings this week, and investors were positioning themselves ahead of the earnings reports. HAC last week maintained its approximate net equity position. It did make some changes in the portfolio. Here you can see it short sold the U.S. material sector using ETF XLB. On average, over the long term, the month of June tends to be one of the weakest months of the year for the material sector. And recently, we've started to see the material sector start to underperform the S&P 500 and show some weakness as well. As an offset to that, though, HAC did increase its position in the S&P 500. And if we take a look here, HAC did take a short position in the U.S. transportation sector using the ETF IYT. On average, over the long term, the transportation sector, one of the weakest months of the year, is June, and starting to also show some relative weakness compared to the market as well. As an offset to that, HAC did enter into an initial position in the biotech sector using the ETF IBB. Now, the biotech sector has a strong seasonal period from June 23rd until September the 13th. So we're a month away from the start of the seasonal period, but we're starting to see some positive signs that maybe this is a good time to be actually taking advantage of the seasonal opportunity early. If we take a look at this chart here, you can see here that this top panel is IBB, the ETF, representing the biotech sector, and the next panel down is the biotech sector relative to the S&P 500. And look, since the beginning of February or early February, we've seen the biotech sector underperforming the S&P 500. But it's starting to consolidate relative to the S&P 500, and also it's up in the month of May as well. So right now, this could be an interesting opportunity to actually be in the biotech sector ahead of its seasonal period. If we take a look at the other sectors of the market, first of all, let's use the S&P 500 as a reference here in the red at 0.4%. So what happened last week? We saw that all of the cyclical sectors, the major cyclical sectors, industrials, materials, energy, and financials, underperform and negative for the week. So where the money flow on relative basis, technology was actually positive last week. And on top of that, the defensives were all positive. So you saw consumer staples, healthcare, utilities, and real estate positive and outperform the S&P 500. So what's happening in the markets right now? Well, it's really interesting because last week, the yield on the 10-year Treasury note was flat. Started the week at 1.63% and ended the week at 1.63%. So this provides a good reference point because what we've seen is the macros really driving a lot of the market. Sure, recently we've seen some big economic reports such as the non-farm payroll number and the CPI numbers really move the markets. And also, too, we've seen the earnings season influence the markets as well. But we're largely past, for the U.S. market, the main brunt of the earnings season. And so macros start to become more important, and interest rates movements start to become more important. Interest rates really are the lens of what's taking place a lot of times in the marketplace. So when interest rates are rising, it's usually the cyclicals that outperform. And when interest rates are falling, it's often been recently the technology sector that's been outperforming. So last week it was flat. So it provides a good benchmark to see the sentiment for investors. And what we saw last week was investors stayed away from the cyclical sectors on a relative basis, went to the technology sector, and it was positive, but also to the defensive sectors. So what this is indicating is that, yes, investors still want to be involved in the markets, but they're starting to become defensive, and they want to be defensive at this time. Now, on a seasonal basis, the defensive sectors of the market tend to have their seasonal period at this time. So we're seeing things line up quite well on a seasonal basis. But just given the fact that interest rates were flat and investors were still had a preferential treatment towards the defensive sectors, it's still indicating that investors still want to be defensive. Thank you very much.